Welcome everyone. Today is July 24th, 2025, and the digital asset landscape is once again proving why it's one of the most exciting, albeit nerve-wracking, markets to watch. In recent days, we've witnessed a dramatic showdown where Bitcoin, the undisputed king of cryptocurrencies, has been wrestling with a formidable price ceiling. This struggle has sent ripples across the entire ecosystem, affecting nearly every other digital coin and token in its orbit. The market is currently in a state of high tension, with investors and traders eagerly waiting to see which direction the momentum will swing next. It's a classic tug-of-war between bullish optimism and bearish caution, and the outcome remains uncertain. The central story revolves around Bitcoin's ambitious attempt to smash through the $120,000 resistance level. This psychological and technical barrier has proven to be a tough nut to crack, leading to significant price fluctuations that have kept everyone on the edge of their seats. As is often the case, when Bitcoin sneezes, the rest of the market catches a cold. We saw this play out with many popular altcoins which first soared on the back of Bitcoin's momentum, only to plummet just as quickly when the giant stumbled. This kind of volatility is a hallmark of the crypto space, reminding us all of the inherent risks involved in this high-stakes game. Amidst this widespread turbulence, a fascinating and unexpected narrative has emerged. A lesser-known but widely discussed project, the PI token from the Pi network, has demonstrated remarkable resilience. While major assets were experiencing sharp downturns, PI managed to hold its ground, and in some instances, even post modest gains. This unusual stability has captured the attention of the community, raising important questions about its underlying strength and what makes it different from its peers. Is this a sign of genuine investor confidence or simply a temporary anomaly in a chaotic market? We'll dig into that. In this essay, we will take a detailed look at these unfolding events, breaking down the key factors at play. We'll explore Bitcoin's price action, the dramatic rise and fall of various altcoins, and the curious case of the PI token's steadfast performance. Furthermore, we will delve into expert predictions for PI's potential value, including speculative forecasts from sources like BitGet, while making it absolutely clear that these are not financial advice. Finally, we'll consider what the near future might hold for Bitcoin and the broader crypto market, examining the critical levels that could dictate the next major trend. Let's get into it. The past week has been a nail-biting spectacle for Bitcoin investors. The world's leading cryptocurrency mounted a series of determined assaults on the $120,000 price point, a level that has now cemented itself as a major psychological and technical resistance zone. Each time Bitcoin's price approached this ceiling, it was met with overwhelming selling pressure, pushing it back down. This repeated failure to achieve a clean breakout signals a palpable hesitation in the market. It suggests that while there is strong buying interest, there are also many investors poised to take profits around this key level, creating a formidable wall that has, for now, halted the upward momentum we saw just last week. Following its most recent rejection, Bitcoin experienced a sharp and swift decline, shedding nearly $4,000 in value. The price tumbled from its high perch to just over $116,000, sending a wave of concern through the market. This drop served as a stark reminder of the volatility that can strike at any moment. Since that dip, the price has managed a partial recovery, clawing its way back to hover in the $118,000 to $118,852 range, according to data from A-Invest and Binance. This zone has now become a tense battleground where bulls and bears are locked in a struggle for control, with neither side showing a clear advantage as of today, July 24, 2025. Technical indicators are starting to paint a more cautious picture, adding weight to the bearish sentiment. For instance, the Moving Average Convergence Divergence, or MACD, a popular tool for gauging momentum, has turned bearish for the first time since the beginning of July. This shift suggests that the bullish energy that propelled the recent rally may be waning, while the Relative Strength Index, or RSI, remains relatively high at around 65, indicating that buying pressure still exists. Its momentum is visibly slowing down. These signals from the charts, as reported on TradingNews.com, are telling traders to be on high alert for a potential trend reversal or a period of prolonged consolidation. On-chain data presents a more complex and somewhat conflicting story. On one hand, recent weeks saw a net outflow of 11,700 BTC from exchanges, a bullish sign that often indicates large holders or whales are accumulating coins and moving them into long-term storage. However, a more recent trend has emerged showing the largest net inflow of Bitcoin to exchanges in over a year. This suggests that some of these long-term holders might now be positioning themselves to sell, possibly anticipating a price drop or simply looking to realize their substantial profits. This push and pull between accumulation and potential distribution is what's creating the current market standoff. The turbulence surrounding Bitcoin's struggle at the $120,000 mark had an immediate and profound impact on the broader altcoin market. For a brief period, it seemed like alt season was in full swing. Countless alternative cryptocurrencies were riding high on Bitcoin's coattails, posting impressive gains and generating a wave of excitement among investors. The total altcoin market capitalization had surged by a staggering $216 billion over just 2 weeks, a testament to the feverish buying activity. However, this euphoric rally proved to be incredibly fragile, built on a foundation that was quickly shaken as soon as Bitcoin showed signs of weakness. The moment Bitcoin faltered and began its retreat from the $120,000 resistance, the altcoin market experienced a sudden and brutal reversal. The vibrant green candles that had dominated the charts were swiftly replaced by a sea of red. The gains that had taken days or even weeks to accumulate were wiped out in a matter of hours for many tokens. This sharp downturn illustrates a classic crypto market dynamic. Altcoins often act as a high beta play on Bitcoin. They tend to amplify Bitcoin's movements, rising faster during a bull run but also falling much harder and faster during a correction, a painful lesson for many traders this week. One of the key reasons behind this rapid reversal was the excessive leverage in the system. Market data from Ainvest indicated that open interest dominance, which measures the amount of speculative capital in the market, had reached 38%. This was the highest it had been since April 2023. Signaling that the market was significantly overbought and highly susceptible to a correction. When prices started to fall, it triggered a cascade of liquidations for these leveraged long positions, which in turn accelerated the sell-off. It's a domino effect where forced selling begets more selling, leading to the kind of sharp, painful drops we witnessed. This event serves as a crucial reminder of the interconnectedness of the cryptocurrency ecosystem. While many projects boast unique technologies and use cases, their market performance remains deeply tethered to the sentiment surrounding Bitcoin. For the time being, Bitcoin continues to be the tide that lifts or lowers all boats. The recent reversal highlights the importance of risk management for anyone invested in altcoins. The potential for outsized returns comes with the guarantee of outsized volatility. And the market has once again demonstrated just how quickly fortunes can change when the primary driver, Bitcoin, hits a roadblock. Among the many altcoins that suffered during the market-wide correction, several popular names stood out for the sheer speed and scale of their reversal. Tokens like Hype, Stellar, also known as XLM, and Hedera, or HBAR, were poster children for this phenomenon. These assets had been darlings of the recent rally, attracting significant attention and capital as investors sought the next big winner. They posted double-digit percentage gains, fueled by the optimistic sentiment that permeated the market. Traders were piling in, hoping to catch the wave, which pushed their prices to new local highs and created a sense of euphoria around their prospects. However, the celebration was short-lived. As soon as Bitcoin's momentum stalled and its price began to tumble, these high-flying altcoins were among the hardest hit. They hemorrhaged value at an alarming rate, with their price charts showing steep, cliff-like drops that erased a significant portion of their recent gains almost overnight. For investors who bought in near the top, it was a brutal and swift lesson in market dynamics. This rapid decline underscores the inherent risk associated with many altcoins, which often lack the deep liquidity and established support levels of a larger asset like Bitcoin, making them more vulnerable to sharp sell-offs. The case of Ripple's XRP, another major altcoin, followed a similar pattern, providing further evidence of the widespread nature of this reversal. According to analysis from Binance, XRP broke below its key July uptrend line, a technical signal that suggests its bullish momentum has been exhausted for the time being. Furthermore, its MACD indicator also flashed a bearish signal, mirroring the trend seen with Bitcoin and indicating that selling pressure could intensify in the coming days. When a major asset like XRP shows such clear signs of weakness, it often reinforces negative sentiment across the entire altcoin space, encouraging more investors to sell first and ask questions later. This tale of volatility serves as a powerful case study for anyone navigating the crypto markets. The allure of quick profits can be incredibly strong, especially when multiple assets are surging simultaneously. However, the recent performance of HYPE, XLM, and HBR demonstrates that what goes up can, and often does, come down just as fast, if not faster. Their story is a clear illustration of how market sentiment, heavily influenced by Bitcoin's trajectory, can be the primary driver of price action, often overshadowing the specific fundamentals or technological advancements of any individual project during periods of high market stress. In stark contrast to the widespread carnage seen across the altcoin market, the PI token, associated with the PI network, charted a remarkably different course. While established and popular cryptocurrencies were experiencing severe downturns, PI stood out as a rare pocket of green in a market painted almost entirely red. Reports from A-Invest and Binance highlighted its unique performance, noting that the token not only avoided the drastic sell-off, but actually managed to maintain its value. This stability was a significant outlier and immediately caught the eye of market observers, who were searching for any sign of strength amidst the chaos. The resilience of the PI token was not just about avoiding losses. In some trading sessions, it even posted modest gains. This performance was particularly noteworthy given the circumstances. Typically, during a market-wide correction triggered by Bitcoin, nearly all digital assets move in lockstep, falling together as fear and panic spread. PI's ability to decouple from this overwhelmingly bearish trend was highly unusual. It behaved more like a stablecoin than a speculative altcoin, holding its ground firmly while giants of the industry were faltering. This created a compelling narrative that set it apart from thousands of other projects. This standout behavior has naturally led to a surge in discussions within the crypto community. On social media platforms and trading forums, investors and enthusiasts began asking what was behind PI's impressive strength. Was it a fluke, or did it point to something more substantial? The token's ability to weather such a violent market storm suggested that its holders were not engaging in the same panic selling that was plaguing other assets. This implies a different kind of investor base, one that is perhaps less reactive to short-term market noise and more focused on the long-term potential of the Pi network project itself. Ultimately, PI's performance during this period of turbulence served as a key highlight in an otherwise gloomy market cycle. It provided a glimmer of hope and a fascinating case study for those analyzing market dynamics. Whether this stability can be sustained over the long term remains to be seen, but its ability to act as a safe haven even for a short period has undoubtedly boosted its profile. This resilience suggests that there is a foundation of investor confidence and belief in the project that is not easily shaken by the volatile whims of the broader crypto market, a quality that is both rare and highly valuable. The unusual strength of the PI token during the recent market downturn begs a deeper question. What factors contributed to this resilience? A primary reason likely lies in the unique nature of the Pi network and its community. Unlike many cryptocurrencies that are primarily traded by speculators on open exchanges, a large portion of PI tokens are held by a vast global user base that mine them on their mobile phones. This community is often composed of long-term believers in the project's vision of creating a simple, accessible cryptocurrency for everyday people. Their attachment to the project may be less about short-term price fluctuations and more about its future potential. This community-driven foundation means that many PI holders are not typical traders who are quick to sell at the first sign of market trouble. They have been accumulating PI over a long period, often before it even had a speculative price, and are waiting for the project to achieve its major milestone, the launch of the Open Mainnet. This event is seen as the key that will unlock the true utility and value of the PI token. As a result, the selling pressure from this core group is likely to be very low, as they are holding on for a much more significant future event, rather than reacting to the daily or weekly volatility driven by Bitcoin's price movements. Furthermore, the current trading of PI exists in a somewhat limited and speculative environment. As of July 2025, Pi Coin is not yet officially listed for open trading on major global exchanges like Binance or Coinbase. The prices seen are often based on IOU markets or off-market peer-to-peer trades. This limited liquidity can be a double-edged sword, but in this case it may have insulated the token from the broader market panic. With fewer avenues for large-scale, high-frequency trading, PI was not as exposed to the cascading liquidations and algorithm-driven sell-offs that hammered other more widely traded altcoins. Finally, the resilience of PI suggests a growing and tangible confidence in the underlying strength of its ecosystem. The project has been in development for years, steadily building its user base and developing applications within its enclosed network. This slow and steady approach appears to have fostered a strong sense of belief among its followers. They see the project's progress as a more important indicator than the temporary storms in the wider crypto sea. This underlying faith, combined with the unique distribution model and limited trading environment, created the perfect conditions for PI to stand firm while others fell. With the PI token demonstrating such surprising stability, many are now looking ahead and wondering about its future potential value, especially once it becomes fully tradable. It's important to remember that all price predictions are highly speculative, but they can offer a glimpse into market sentiment and perceived potential. One of the more prominent forecasts comes from the crypto exchange BitGet, which, according to reports from A-Invest and TradingNews.com, has projected a potential price range for PI of $50 to $100 by the end of 2025. This optimistic prediction is heavily contingent on a successful and timely launch of the open mainnet. Other analysts have offered a variety of forecasts, reflecting the uncertainty and high expectations surrounding the project. A more conservative cluster of predictions suggests a price range of $30 to $60 in 2025. This estimate likely factors in potential challenges, such as the gradual release of a large supply of tokens onto the market, which could temper the initial price surge. These analysts believe that while the project has strong community support, its value will ultimately need to be proven through real-world utility and adoption on the open mainnet before it can sustain higher valuations, as noted in reports on Binance. On the more bullish end of the spectrum, some commentators are floating even more ambitious numbers. These highly optimistic scenarios envision PI coin potentially reaching $150 or more post-launch. This forecast is based on the assumption of a perfect storm of positive events, a flawless mainnet launch, rapid listing on all major exchanges, and most importantly, mass adoption of the Pi ecosystem for actual payments and applications. The sheer size of the Pi network's user base, estimated to be in the tens of millions, is the primary driver behind these bullish takes, as it represents a massive built-in network effect that few other projects can claim. It is crucial to understand that these figures are not certainties. They are educated guesses based on available data and market precedents. The final price of PI will depend on a multitude of factors that have yet to play out. The development team's ability to execute their roadmap, the token's utility within its ecosystem, the overall sentiment of the crypto market at the time of launch, and the behavior of its millions of holders will all play a critical role. These predictions provide a fascinating spectrum of possibilities, but the true test for PI will begin only when its network becomes fully open to the world. While discussing potential price targets like $5,100 or even $150 for PiCoin is exciting, it is absolutely essential to approach these numbers with a healthy dose of skepticism. It must be stated in the clearest possible terms. These predictions are not financial advice. They are speculative forecasts made by analysts and organizations based on their interpretation of the project's potential and market trends. The cryptocurrency market is notoriously unpredictable, and a host of unforeseen factors can, and often do, render even the most well-researched predictions inaccurate. No one has a crystal ball that can show the future with perfect clarity. The biggest variable in all these predictions is the successful launch of the Pi network's open mainnet. This is the single most critical milestone ahead for the project. A smooth, secure, and on-schedule launch could ignite a wave of positive sentiment and validate the higher price predictions. However, any delays, technical glitches, or security vulnerabilities could have the opposite effect, severely damaging investor confidence and undermining the token's value. The entire foundation of PI's future price rests on the development team's ability to deliver on this core promise, and until that happens, all valuation models remain purely theoretical. Furthermore, the concept of supply and demand will come into sharp focus once the mainnet is live. The Pi network boasts a massive user base, each holding a certain amount of mined PI. When the market opens, the price will be determined by how many of these millions of users decide to sell their tokens versus how many new investors want to buy them. If a large portion of early adopters decides to cash out immediately, the immense selling pressure could suppress the price significantly. Conversely, if most holders continue to hold in anticipation of future growth and strong new demand emerges, the price could soar. Ultimately, the long-term value of PI will be determined by its utility. A cryptocurrency's price cannot be sustained by speculation alone. It needs a reason to exist and be used. For PI to reach and maintain high valuations, it must be adopted for real-world transactions, power decentralized applications, and offer tangible benefits within its ecosystem. Will people use it to buy goods and services? Will developers build on its platform? These are the fundamental questions that will decide whether PI becomes a lasting success or just another flash in the pan. The current predictions are merely a starting point for a story that is still being written. As we stand at this crossroads on July 24, 2025, the entire crypto market appears to be holding its breath, with its immediate future hanging on Bitcoin's next move. The key question on every trader's mind is whether Bitcoin can muster the strength to finally break through the formidable $120,000 resistance and charge toward a new all-time high, which currently stands at $123,218. A decisive breakout above this level would likely inject a powerful dose of bullish sentiment back into the market, signaling that the upward trend is still intact and potentially triggering another widespread rally across the board. Conversely, the downside risk is just as significant. The $116,000 level has emerged as a critical line of defense for the bulls. If Bitcoin fails to hold this support and breaks down further, particularly below the $114,000 to $115,000 range, it could open the floodgates for a much deeper correction. The next major support zone lies significantly lower, around the $110,000 to $111,000 mark. A drop to these levels would confirm a short-term bearish trend and would almost certainly lead to cascading sell-offs across the altcoin market, as investors rush to de-risk their portfolios in the face of mounting uncertainty. The stakes are incredibly high. For the altcoin market, the path forward is almost entirely dependent on Bitcoin's direction. If Bitcoin breaks out to the upside, we could see a powerful resurgence in altcoins like Hype, XLM, and HBAR, as confidence returns and speculative capital flows back into higher-risk assets. However, if Bitcoin breaks down, the pain for altcoins would likely be even more pronounced than what we've already seen, with the potential for further sharp declines. Investors in this space must remain vigilant, as the fate of their holdings is intrinsically linked to Bitcoin's performance in the coming days and weeks. And what does this mean for the PI token? Its future is a fascinating tale of two narratives. In the short term, continued market volatility could further highlight its unique resilience, potentially attracting more attention as a stable outlier. However, its long-term destiny is tied not to Bitcoin's chart, but to its own developmental roadmap. The upcoming mainnet launch will be its moment of truth. A successful launch could allow it to forge its own path, driven by adoption and utility, regardless of wider market trends. The crypto world will be watching closely to see if Bitcoin can lead the next charge, and if PI can finally step onto the main stage.